Hey everyone, it's Matthew Haraburda here, CIO at Bernardo Wealth Planning. Just wanted to reach out as we just wrapped up 2025 and give our outlook for 2026. So if we look back for 2025, across almost all asset classes, you really saw strong performance. From the equity markets, both domestically and internationally, to the fixed income markets, everyone had quite a good year. So where does that leave us thinking about portfolios and positioning for 2026? So obviously one of the major themes that we spoke about last year was the AI and the concentration that we've seen within the market. We don't think that story is going to go away anytime soon, but we do think what is going to change there is that the dynamic of the supply and demand of data centers that have driven so much of the GDP growth that we've seen and really supported the economy, I think that you'll start to see more volatility surround that. Like very similarly in the 2000s when they were building out the telecom industry and everyone was laying fiber, at some point the supply has to meet or exceed the demand because we all know that the demand cannot keep going up at the rate that it has been here for the last several years. One of the new themes that we think is really going to be big this year is the affordability gap that we've started to see. And while we're already into 2026, the last 7 days or so have been really apparent that this is something that the administration is going to look at. So when we talk about things such as Fannie and Freddie being pressured to purchase mortgages to bring down mortgage rates for single family homes for individuals, to institutional investors being pressured not to purchase single family homes, to capping interest rates on credit cards at 10%. Well, we don't think any of those things are absolutely going to happen or not happen. We think it's very clear that there's pressure within that industry because as we look back to last year and looking forward, there is a very clear divide within the economy between higher earners and lower income households. Clearly, lower income households are feeling a little bit more pain because inflation, still above the 2% target, has continued to be sticky, which typically impacts those households disproportionately more. With that said, continue to think there's going to be volatility surrounding a lot of the announcements that we see. It seems like every day we come in and there's a year's worth of headlines within a month or two. So we do think that every time, if we think back now to Liberation Day with the tariff war and everything that was going on there, the market did hit a breaking point when we saw interest rates going up significantly. There have always been people that have stepped in. Scott Bessent, head of the Treasury, has been that primary person that we've really relied on and kind of look to whenever there's these bouts of volatility and a lot of uncertainty to quote unquote put the bumpers up on the bowling lane, so to speak, to make sure that things continue down in an orderly fashion. So with that said, we do think there's going to be continued volatility, but looking through all of the noise that we hear on a day-to-day basis, we want to look at these people that really have experience and that have shown time and time again thus far in the last couple of years that they really make sure that things are reasonable and on the right track going forward. One of the big items that has now come back to light here, again in early 2026, is Fed independence. Was really great to see the video that Jerome Powell made, really standing up for not only himself, but just the independence of the Federal Reserve. And you've seen a lot of large CEOs, Jamie Dimon, and a lot of previous members of the Federal Reserve come out and band together and really make sure that we have that Fed independence. So that's something to continue to monitor and look at. So when we take everything into account and we give our prognostication for this year, continue to think that it is best to de-risk portfolios, both on the equity and the fixed income side. So while we are talking about a variety of different outcomes that we could have this year, we feel that if we stay disciplined, we continue to rebalance and look at accounts, that we'll be prepared for whichever one shows up. So if you have any questions, please feel free to reach out to your advisor or myself directly. And thanks so much. Bye.